The world's financial map just flipped. China has cut its US Treasury holdings to $757 billion, the lowest in 16 years. BRICS countries from India to Saudi Arabia are selling too, moving into gold and new financial centers outside Washington's reach. Yet in a shocking reversal, US allies are racing in. Japan now holds a record $1.1 trillion. The UK has surged past China with $858 billion. And France and Israel are buying at breakneck speed, despite their own spiraling debts and wars. Bloomberg says foreign ownership of treasuries hit an all-time high of $9.1 trillion. But Reuters warns the buyers are shifting to short-term bets, not long-term trust. America's lifeline is being propped up by allies already near the breaking point. And the danger is what happens when their money runs out. The numbers on the US Treasury screen don't look like they're supposed to. For the fourth month in a row, China's holdings of American government bonds have fallen, slipping to $756.3 billion in May 2025, the lowest since 2009 according to US Treasury data, reported by Reuters on July 17, 2025. A decade ago, Beijing sat on more than $1.3 trillion, the world's largest stockpile of treasuries. Now it is letting that position erode, month after month, pulling cash from Washington's most vital lifeline. At the same time, the overall pool of foreign holdings has never been higher. As Bloomberg noted on August 15, 2025, foreigners now hold $9.13 trillion in treasuries, almost $1 trillion more than last year. The United States is leaning harder than ever on outside money to roll over its debts, but the composition of that money is changing. The surge is not coming from China or other BRICS members. It is coming from U.S. allies. Japan has been the most aggressive. In June 2025, its holdings rose to $1.147 trillion, the highest ever recorded, according to Reuters on August 15th. That put Tokyo firmly in the position of America's largest creditor. The United Kingdom, usually a step behind, has overtaken China as the second largest holder, lifting its stockpile to $858.1 billion in June. France, though smaller, added $70 billion over the past year, while Israel increased its holdings by 46%, a jump of $32 billion, according to Treasury data summarized in the Financial Times. The balance is shifting from rivals to allies, and that shift is deliberate. BRICS governments are going the other way. India trimmed holdings by $14 billion in 12 months, according to Bloomberg in July. Saudi Arabia reduced its position as well, despite running some of the world's largest trade surpluses. Brazil sold steadily, moving dollars into other assets. The Financial Times reported in January 2025 that China had cut direct treasury holdings by $57 billion in 2024 alone, rerouting some through custodians in Belgium and Luxembourg, making the decline look smaller than it is. What are they doing with the cash? The FT noted that China's central bank bought 15.24 tons of gold in late 2024, one of the largest quarterly purchases worldwide. Bloomberg's May coverage pointed out that Beijing has been sending physical bullion back from vaults in the West to new storage facilities in Shanghai and Shenzhen. These are not random moves. They are structural, replacing dollar assets with gold bars and local currency trade credit. Meanwhile, the countries stepping in have their own fiscal stress. The United Kingdom's government borrowing costs hit their highest level in 27 years this summer, according to Bloomberg on August 22nd. France's bonds now yield more than Greece's, a fact highlighted by Reuters in July, raising questions about Paris's ability to fund its commitments. Israel, facing expanded defense operations against Iran and Hamas, has pushed borrowing needs to levels unseen in decades. And Japan, with record spending on pensions, healthcare, and defense, now faces the highest debt service costs in its history. These buyers are not strong because their balance sheets are clean. They are strong because their political calculus is clear: support Washington even at cost to themselves. That choice is not guaranteed to last. In May 2025, foreign central banks sold $19.6 billion of long-term treasuries, preferring to buy short-term bills, according to Barron's analysis of Treasury data. It suggests caution investors are willing to park money in Washington, but only for a few months at a time. Long-term faith is thinner. Let's pause, because this wasn't supposed to happen. Not yet. The United States built a model over 4 decades in which its trade deficits recycled back automatically as foreign demand for treasuries. From 1980 through 2011, over $8 trillion of U.S. trade deficits were reinvested into government bonds, a textbook balance of payments loop. The IMF described it as a system that sustained both American consumption and global growth. That loop is breaking. Dollars earned in BRICS trade no longer circle back. They are going into gold, local currency settlements, or alternative banking centers in Hong Kong, Dubai, and Riyadh. China is lending dollars abroad at lower rates than Washington itself pays, according to Bloomberg's July bond market survey. Russia under sanctions has not collapsed but used restrictions to deepen energy trade with Asia. Saudi Arabia still prices oil in dollars but recycles fewer of those dollars back into treasuries. These shifts challenge the assumption that U.S. deficits are self-funding. If the BRICS are systematically removing themselves, then allies' recent purchases are not just supportive gestures. They are firefighting. Consider the numbers in sequence. Japan added $56 billion in 12 months. The UK added $112 billion. France, $70 billion. Israel, $32 billion. These increases match almost exactly the sales recorded from China, India, Brazil, and Saudi Arabia over the same span. Reuters data in August confirmed that the net effect is balanced. Total foreign holdings rose to record highs, but the identity of the holders changed. If U.S. deficits require ever larger purchases and only a handful of allies are willing, the strain intensifies. The Congressional Budget Office projects more than $2 trillion in new federal borrowing each year through 2028, largely to cover rising interest costs. Net interest payments are on track to exceed $1 trillion annually by 2026, crossing 10% of federal revenue, according to CBO's July 2025 update. Allies can absorb some of that, but not indefinitely. The market signals reflect the tension. Yields on 30-year treasuries have climbed to around 5% in September 2025, Bloomberg reported on September 3rd, the highest since before the global financial crisis. UK gilts of similar maturity are yielding at levels last seen in 1998. Japan's 20-year notes carry yields unmatched since 1999. Investors are demanding more to hold sovereign debt. If allies keep buying, they do so at a rising cost, both to themselves and to Washington. The question becomes whether this reshuffling is sustainable. Can politically aligned but fiscally constrained allies continue to underwrite U.S. deficits while BRICS reduce exposure? Look at the fragility. France faces the risk of snap elections amid debt disputes. The United Kingdom wrestles with the steepest borrowing cost rise in the G7. Japan must fund simultaneous military expansion and welfare costs for a rapidly aging population. Israel is in an open-ended conflict. Each is stretching already. Their willingness to buy treasuries is clear. Their capacity is less so. Meanwhile, China's steady drawdown is not panic selling. It is a long, slow reallocation. Reuters emphasized that May's level was the lowest since 2009, but the descent has been stepwise, not a crash. That suggests careful management, reduce exposure without triggering market collapse. Gold reserves rise. Custodial accounts in Belgium and Luxembourg conceal true holdings. Short-term bills replace long-term notes. The objective looks like insulation, building buffers while still maintaining enough U.S. assets to avoid confrontation. Foreign equity flows complicate the story. In May 2025, foreigners bought $114.3 billion of U.S. stocks, reversing April's outflow, according to Treasury data. This suggests confidence in American companies, even as confidence in its long-term bonds weakens. The separation between Wall Street equity appetite and Washington debt appetite shows investors hedging chase growth while minimizing sovereign exposure. The IMF's April 2025 reserve currency report added another layer. The dollar's share of global reserves has slipped to 58%, down from over 70% 2 decades ago. The renminbi's share has risen to about 6.8%, which is small but expanding. Gold holdings in official reserves are at their highest proportion since the 1970s. This is not de-dollarization in a single leap. It is a rebalancing carried out gradually, country by country, year by year. By late summer 2025, the United States faces a dual reality. Its debt auctions remain oversubscribed, thanks to allies and private investors. Yet its most powerful rival is unwinding holdings, diverting trade surpluses elsewhere, and reinforcing alternatives. The allies stepping in are politically committed, but financially fragile. The U.S. itself must refinance trillions at higher yields each year. That's the landscape. Foreign support rising, but reliability thinning. Allies buying, but straining. Rivals selling, but careful. The treasury market is balanced, but precariously so. The vulnerability isn't only in Washington. Hedge funds have taken record positions in U.S. Treasury futures, betting on volatility, according to the CFTC's July 2025 report. These leveraged trades, they really magnify swings in yields. When foreign central banks trim holdings, funds step into arbitrage, adding instability. The Wall Street Journal noted in August that open interest in Treasury futures is at its highest since 2008. Foreign official demand is now concentrated in shorter maturities. Treasury auction data from June shows 65% of foreign bids went to bills with maturities under 1 year, up from 48% 2 years ago. This reflects caution. Support remains, but not long-term. At the same time, sovereign wealth funds are diversifying. Norway's government pension fund Global disclosed in August that its dollar-denominated bond allocation fell below 30% for the first time, shifting into equities and non-dollar assets. The signal is clear. Even allies are trimming dollar exposure at the margins. Credit default swap prices for U.S. sovereign debt, thinly traded but symbolic, have ticked higher. Bloomberg reported in late August that one-year CDS spreads on U.S. Treasuries doubled compared to early 2024, suggesting rising anxiety over fiscal risks. And yet demand persists, not out of confidence, but lack of alternatives. Eurozone bonds are burdened by fragmentation. Japanese debt yields too little. Chinese assets carry political risk. The U.S. remains the least imperfect option. That reality sustains demand for now. But least imperfect is a fragile foundation for the world's largest borrower. If the United States can no longer rely on rivals to recycle its deficits, and allies already stretched thin are the only ones stepping in, what happens the moment those allies reach their limit? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.